Okay, let's start with Alyssa's question here. She asks, can you help me understand why the program has them spending every dollar by the end of their plan? How do you ensure that they won't run out of assets if they live longer than expected or asset returns are lower than expected?
So we're assuming that they live to their maximum age of life in the program. So, and you specify that right here. If you thought their maximum age of life was actually even higher than 100, you could make it 110. That's the maximum age of life. So we're being really cautious on the length of the plan. So they're not dying we're not assuming they're going to die on time at their life expectancy, because nobody dies at their life expectancy. We're assuming, as economics says we should do, assuming that their planning horizon is their entire maximum lifespan, because it could happen that they live that long, and you have to provide for that case. Now, the issue about returns, well, we're assuming very conservatively that they earn nothing in real terms above inflation on their investments, either retirement account investments or their regular assets, nothing. And that's based on what the market's now, saying is the case. So it's quite conservative because we're assuming they're not investing in any higher yielding securities than TIPS. But a week from this Friday, I'm going to be talking about how the program takes into account portfolio return risk, investment risk, asset return risk, and I'll show you precisely how we consider that. So the program has these reports, which are the base plan, the maximized plan. So these are both working off of kind of a certainty equivalent, very conservative assumptions. We're trying to get people to plan based on conservative assumptions, careful assumptions, safe assumptions about labor income and about returns and about how long you can work. And then the maximization is also using those assumptions. But then the Monte Carlo risk analysis, which I'll talk to you at the next webinar about, that does incorporate the possibility that the returns are not going to be safe and for sure, and that they're risky. Now, the other question you raised was them running out. So one of the things you can do is tell the program that under where you enter assets, that you can enter a new asset that could be called a reserve fund. And you can say what kind of an asset it is. It might be let's say it's a checking account, or maybe it's a savings account, withdrawal fund. And is it a reserve fund? You specify yes, and they balance, maybe it's whatever amount. And now the program will not spend that money. So they will die with that amount of money. The other thing is that in the base plan, or in any of these plans, the program does not sell the house unless you would specify, or the client would tell you to specify that the house is going to be sold. So they're always going to be dying with the equity in the house. And then the third thing you could do is you could specify under, you can go here and pull up special expenses and specify, for example, a gift, or let's say an emergency fund. And say you want to accumulate an emergency fund of a certain amount, you put it in here. And when you're going to actually, let's say you specify that expenditure on the emergency fund is going to happen in 20 years. And it's going to be just a 1-year expenditure. So it's going to start in 2040 and it's going to end in 2040. And maybe it's $200,000. So put all these amounts in here, these numbers. And then the program is going to know that it has to save up for that outlay. So that's another way you can enter, you can tell the program not to spend all the resources, even if the household lives to their maximum age of life, to keep some stuff on the side. And you could specify this emergency fund expenditure outlay to occur in the year they turn 100. So the program will know that it has to make this outlay in that very last year, and it'll save up for it. And then the client, if you put in $1 million here, the household will be making $1 million outlay in the last year, and obviously that's just money that they have in a piggy bank in case something comes up. And you'll see that showing up in their regular assets report. You'll see that they'll have much higher regular assets. Okay, what's the next question, Alex?
Okay, yeah, let's move to the next question. This is from Larry. He asked, is the program just a retirement planning tool?
Well, no, it figures out for any household at any age. I mean, suppose you're a 25-year-old kid out of, maybe you just got your MBA, and maybe you just got married, or maybe you're single, and you want to do planning about, how large of a house can you buy? So you put in your projected earnings, you put in anything about, the job you have and the retirement account contributions, you put in any initial assets that you currently have, and then you would look at buying a house. Maybe you're renting right now, and you could say, hey, there's going to be a change in my housing in 5 years. I want to buy a house with this down payment, and you'd specify the down payment and this size house, and then you can immediately see, gee, how much is buying a house that size reduce my living standard? Because I'm going to have to put down a large amount of money. If it's an expensive house, you'd specify the price of the house that you're going to buy. So that's just one example. Another example would be, maybe you're 25 and you don't have any kind of advanced degree. You've been out of college for a couple of years. You're thinking about, maybe you've got a BA in English, and now you're teaching in high school English, and you notice that the teachers that have an MA, a master's degree in English, are getting a higher salary. So you're thinking about, should I go and get training, take a couple years off, get a master's in English, and come back and teach at a higher salary? Well, you set up an alternative profile. It's really easy to set up an alternative profile. Just come down here, click on Add New Alternative Profile, set up the name of it. It's going to copy the profile that you were on. So if you're talking about the base profile for this person, it would just copy that one. And now you can set up this alternative universe in which this person has no earnings for a couple of years, has to pay tuition, and then has higher earnings for those 2 years, and also room and board, continue to pay housing expenses. But then after those 2 years, that the salary is going to be higher. So you can use this for career.
So,
yep.
Right. Yeah. I wanted to just interject for a second, because that was Larry's other question, which is how does the program handle a wage earner who wants to change careers in 3 years with compensation greatly reduced? You would make an alternative profile in that case. Right.
Make an alternative profile. You just specify that the salary is going to drop. You can do that very easily right here under the current earnings. You just specify, you just click here, you click here, and you say this, it goes through a specific number of years, and then there's a change in earnings thereafter. You click on this thing right here. It's a little hard to see, but that's where it is. So you can specify that entire path of high earnings and then low earnings. So this program could be used by an 80-year-old too. What does an 80-year-old have to decide? Well, they have to decide how fast to spend their assets down. They might have a 70-year-old spouse and they're 80, and they're trying to figure out, if they both lived in the maximum age of life, how much can they save? But maybe also, how much can they give to their kids right now in gifts? How much can they help their kid with a down payment for the house that the child wants to buy, and still maintain a decent living standard on their own? So really, at any financial question about life insurance, this program has a fantastic life insurance calculator, because it's figuring out to the dollar how much life insurance each person needs, each household head needs, and partner or spouse, in order to maintain a living standard to the dollar of survivors. That's why we have, under reports, you can run survivor reports and see and kill off. If you hit run survivor report, you get to kill off you get to ask who's going to die. And then if you say, well, we're going to kill off George, and you can specify when George is going to be killed off, and then you'll see a report that just looks just like the reports I've been showing you for Jean as a survivor, and you can check that, verify that Jean's got at least as high a living standard, if not higher. If she has exactly the same living standards, it means that the program has recommended that George buy life insurance in the year that he hold term life insurance in the year that he dies. So on every issue of personal finance, this program, I think, is the full Monty. Let's go to the next question.
Let's see here. This is a question from Bill. He asked, would the software also consider different types of retirement plans? For example, simple versus SEP versus solo 401ks?
Retirement plans that are have the same tax treatment, we're kind of lumping together. But we are going to, just to make it clear, if you wanted to add a new retirement account, you could specify at least here the name of it, and you could say it's my SEP plan, and you can enter as many retirement accounts separately as you want. If it's got Roth, if it's a Roth plan, you'd specify that it's Roth. If it's an employer-based account, individual account. So we're clumping together account types that have the same tax treatment, but in the near future, we're going to be probably changing this interface a little bit and letting you specify with more detail the particular type of retirement account, and probably doing individual reporting for each type of account that people have. Right now, we separate out reports about Roth accounts from non-Roth accounts, but we're going to probably drill down even more at some point in the next maybe 6 months. We'll start working on improving the software in that dimension, at least in terms of the inputting and the display of the outputs. Next question, Alex.
This is from Hannah. What assumptions does the system use to determine future tax brackets for the optimization?
Okay, that's really a great question, because you might say, well, gee, how does it know if I run the base plan? I'll just run it again, and I'll just show you the tax report. How does it know what the taxes are going to be 20 years from now? Well, we know what the tax schedule is. We know, for example, what things are indexed to inflation in the federal income tax and what things are not. All our tax calculations are being done in nominal terms, because not everything in federal taxes is indexed to inflation, and certainly not in the different state income taxes. So here we have them in the base plan. You can see what their taxes look like, and they're actually zero in these years where the program said, well, we don't want to have them in a zero tax bracket paying zero taxes. Let's get them, let's take some of the withdrawal money and put it into those years, so withdrawals start sooner. Anyway, under the optimization. So how do we actually figure out the taxes simultaneously with figuring out the spending, which is the annual discretionary spending, which is right here. You see the discretionary spending. We're having to determine that discretionary spending, and also any life insurance premiums. If I look at spending overview, I see other expenses where there would be life insurance premium. Oh, here's life insurance premiums, $35 just for 1 year's life insurance. Oh, actually, no, sorry, it's a little bit higher starting out. So here you see all of the fixed expenses, as well as the discretionary spending and the housing expenses. Everything's laid out here. So how do I figure out, how does the program figure out the three things that we're solving for: the path of discretionary spending, the path of life insurance premiums, and the path of taxes, federal and state, and also the path of Medicare premiums, because the path of your discretionary spending affects your path of asset accumulation, affects your path of income, and it can affect your Medicare premiums because it can affect your modified AGI 2 years in the past, because that's what's going to trigger potentially that high Medicare surcharge on your premium. So all these things are being determined jointly. The paths of all these variables are being determined jointly in the algorithm that we have developed for Maxify Planner, which we got a patent for. And what it involves here is 3 dynamic programs that are going back and forth and talking to each other and passing data back and forth until everything is mutually consistent. So it's not like it's a one-pass solution. Underneath the hood, in that half a second that it takes the base plan to run, this program is iterating back and forth between 3 programs in a very clever way to get the results extremely precise. And it's also incorporating dealing with the issue of borrowing constraints. You need to do what's called dynamic programming, which is a solution method that was developed in the 1950s by a guy named Richard Bellman, mathematician. It's used in rocket science to redirect the path of a rocket ship to the moon, if you like, or to the space station. So literally, we have rocket science under the hood here. And it's also used in engineering, dynamic programming, but economists use dynamic programming all the time. This has got 3 dynamic programs that are talking to each other until they agree with each other, if you like. So that's how we do the calculations. So let me take the next question.
Okay, maybe you want to just answer this next question quickly, because I want to get to a number of other questions when we have a bunch of them.
Okay.
This is from Michelle. She's just asking, what's the cost of the software? Is it an ongoing fee or a one-time fee?
Oh, it's a $4.99 for the first year, and then if you choose to renew your license, and we don't force anybody, we don't auto up you. We don't do that. We ask you to come back to our website and renew your license the next year. That's $379. So $4.99 the first year, $379 thereafter. We've kept the prices fixed for our software for many years, and we hope to be able to do that in the future. So this software, compared to eMoney, MoneyGuide Pro, Naviplan, this is incredibly cheap, and I feel that it's doing a proper analysis, and I would argue that Right Capital and these other programs are not doing proper financial planning on any dimension, with whether we're talking about life insurance, whether we're talking about calculating spending, what should be spent and saved this year, whether we're talking about a Monte Carlo risk analysis, portfolio suggestions, advice. We think we have the proper framework, and it corresponds exactly what economists over the last 100 years have developed. And this is just bringing all their work to the marketplace. And we're about $2,000, I think, or so cheaper than those tools per year. And in addition, one other thing really quickly is that there are a couple of things that they have that we don't have, such as account aggregation. We're working on that. We hope to have that either later this fall or earlier in the spring. But we're certainly trying to become, put everything into our program that these other tools have, so that we have complete comparability with respect to all those extra features that we don't now have. Next question.
Yeah, this is a question from Jennifer. She asks, is there a suggested best practice for using this approach to track progress with clients each year? For example, if we were working with Gene and George and we say we're implementing the Maximize plan, then it's a year later, are we updating the assets and rerunning based only on the updated asset profile?
Well, first of all, you can track, you can compare, just one quick thing about tracking how well the client's doing during the year. If you run any of these profiles, you come down here and you can say, set up a progress tracker, and then hit a couple buttons here, and you come to, you can budget. They've got this much to spend on discretionary spending in 2020, And if they spend it the way most households spend it, this would be the allocation, but you can then ask them what are they actually spending on utilities per month, and work up an actual budget for them, and then compare what they're actually spending with what they can spend. So that's one thing. Now, in terms of coming from one year to the next, so the program will, because it will have account aggregation, will be set up to automatically take in the client's assets no matter when you run the program. So you'll have the current assets. So it could be you run it this month, and then the client calls you and wants you to run it again with a different assumption next month. And when you log in, it should be set up to have the client's latest asset information, account balances right there. And the program will be set up when we introduce this account aggregation. We're also going to do rest of year planning rather than entire first year planning. Right now, we're planning going back to January 1st of 2020 for George and Jean. In the future, we'll be planning from, if we're in July, we'll be planning from July through the end of 2020, and then from 2020 beyond into the future, we'll be doing this consumption living standard smoothing from the current month onward, but not going back to the beginning of the year. So we call that rest of year planning. So we're setting that up as well. So the answer is yes. Every time you run the client, you want to be using a plan for the client. You want to be using the latest information. If their labor income has changed, if they've been laid off, if anything's happened, you should be getting that information from the client and entering it into the program. So you're really giving them an up-to-date plan. And it's we also have on our wish list here and our to-do list, putting up a client portal so that you can easily have the client edit the inputs when you're not there. They can edit the inputs, then you can run the program, and they can look at things you've run, and you can look at things they've run. So that's all coming down the road. Next question, Alex.
This is just a quick question about Social Security from Bill. Would the program optimize for spousal benefits and other opportunities for Social Security?
Yes, absolutely. It deals with 11 of the 12 benefits that people can collect: divorce widow benefits, disabled child benefits. I think we have the only calculator that handles disabled children correctly, and children in general. For example, one of the things we just recently added was the fact that if you have a disabled child and you start collecting your retirement benefit, and the child can then get a disabled child benefit. Well, if they're collecting supplemental security income, they'll lose that dollar for dollar. So we now have an input where we talk about, ask about children, ask whether they're disabled. We ask also whether they are now receiving supplemental security income and how much. So that's all part of the optimization. Should let's say the dad retire take his Social Security at 62 because maybe the mom is not working, taking care of the disabled child, and maybe the disabled child is 40 and the mom is 50, and she can collect a child and care spousal benefit because she's taking care of the child. But they can only collect those two benefits, the child and care spousal benefit and the disabled child benefit, if the dad collects his retirement benefit. That's, I think, an awful thing about Social Security, that benefits that these people, a disabled child needs these benefits, but he can't get those benefits until the dad has been forced to take his retirement benefit, and maybe early. So the program is going to say, well, is it the best thing to do? Should the dad take his benefit at 62 so he can get the other benefits going, or should he wait till 65 when his benefit will be higher forever because it won't be reduced as much, and have them wait for a couple of years to get, they'll lose those benefits for a couple of years, but he'll get a higher benefit for the rest of his life. So all these things come into play in the Social Security optimization. We have been working on that code for literally 27 years, and I'm quite sure that we have the best software in the business on this. We have the former chief engineer of the Army Corps of Engineers, doing, he's in charge of our Social Security code. He's just an extremely exacting, anal person, just gets everything right to the letter. And we have a former technical expert from Social Security on our team who worked with Social Security for 30 years, who knows all the rules inside and out. So, but that doesn't mean we have everything. There are hundreds of thousands of rules in Social Security about these 12 benefits, and we're just making sure that we have everything as done to the T that we possibly can. So we're never assuming that we have everything 100% right, because there's so many rules out there. You have to make sure that you do the earnings test and the reduction of the adjustment factor and their recomputation of benefits and the family benefit maximum. Everything has to be done in the right order. It can't just be done haphazardly in order to get the right number. So that's just an illustration of the complexity. Anyway, Alex, next question.
Yeah, this is a question from Michelle. She asks, what is the percent rate that you are using for the annuity? Can you have them set aside money for legacy wishes and not have them run out of money?
Yeah, you can. First of all, you don't have to annuitize 100% of the retirement accounts. You can specify whatever percentage you want. I'm assuming a 1.5% nominal return, and of course the inflation rate is 1.5%. So I'm assuming a zero real return on the annuity. The reason that their living standard goes up because of the annuity is because they get, in effect, mortality credits, because the annuity pays off more than just the return on long-term bonds. It's paying off based on the mortality, because if you die after having bought an annuity, your heirs get nothing, right? So you don't have to fully annuitize, but you can certainly specify gifts to your kids as special expenditures. You can specify a reserve fund, which it'll be money that you'll accumulate. So you can tell the program how much of the reserve fund you have now and how much you want it to be in what year. And you can also specify bequests that would be made in any year that the client dies, and that may trigger the need for life insurance. So there's lots of different ways, including a gift that you can specify as a special expense. Well, I guess I mentioned that later in life to keep money in the plan and not have it spent. So you can fine tune this. This is a real planning tool, and you can get to the client's optimum. It'll take a little back and forth, but you'll get to the sweet spot for sure. Next question.
Okay, we have about 7 questions left. So
Okay.
Let's just try to finish this up quickly. This is a question from Larry. He asks, will the account aggregation also take into account spending information from checking and credit card accounts? And I guess I'll answer that. I think that's probably not in the first iteration, but that is the dream eventually, where we have sort of recommendations where you could compare that with potentially the capabilities of Mint, where people can where you can see what people are doing in real time. I'll ask another question here that's more particular to the program. This is also from Larry. He asks, where do you calculate the proper Roth conversion amount? For example, filling the 22% or 24% tax bracket.
Well, so the program, one part of the robo optimization, this isn't exactly answering your question, but I'll get there, is figuring out whether to take the Roth money first or second. So that's partly, getting at this tax issue. What's the optimal use of Roths in order to get lower your lifetime taxes? Now, the other question is really about Roth conversions. When should you specify a Roth conversion should take place and how much, how much should you specify? Well, I showed you how you can do that in the program where the input actually occurs. I would say the way to do that is to look at our tax report. If you run the, let's say, maybe you're running the base plan, you look at the taxes, you don't have any Roth conversion specified, and you see, well, gee, George and Jean are not paying any taxes until they start taking their retirement account money. Let's have them do a Roth conversion in those years where we know the tax bracket is going to be 0. We can see just with our eyeballs that the actual, total tax payment is lower, or in this case 0, and figure out from that here's the years where I should try the Roth conversion. And if you run a Roth conversion, then you look at as an alternative profile, and then you compare taxes in the base plan with the alternative profile. You can see, gee, have I evened out the taxes across all the years, or not? If I haven't, maybe I want to make that Roth conversion bigger, or maybe I've overdone it. I should reduce it. So that's how you can manually kind of get to the sweet spot. It would be lovely if we could optimize over exactly how much Roth conversion should be done in each year. And we may be able to do something along those lines, but we're worried that it would eat up a huge amount of computation time, because we got a continuous variable, it can run from 0 to all the money that's in your retirement account. And that's why this is not that simple a thing to solve for. So there's too many options. Anyway, next question, Alex.
Okay, this is also a question from Larry. He asks, how does the program handle stock compensation?
Well, you would enter that as a special receipt that's taxable at well, if it's taxable at ordinary rates, if it's if you think there's going to be you've been given a so basically you just enter that as a special receipt. It might be stocks that you're going to get in the future. Might be you're given some options and then they're going to convert, be realized at some date in the future. And the tax treatment of options has changed over time. So if you get the options right now and you have to pay taxes on them, you just treat that as a special receipt you receive right now. But if you think there's going to be some capital gain that's going to come in the future, then you'd enter that. And if that's a special receipt that's going to be taxed at capital gains rate, you'd specify special receipt taxable at capital gains rates. So you have that option when you enter special receipts. So I think that's how you would deal with it that way. And if you were unclear what to do, you would give us a shout. We have great customer support. We have a great help center with all kinds of FAQs, and you can even, can always chat me up, kotlikov@gmail.com. So always happy to talk to planners who need some help. Anyway, next question, Alex.
Okay, so we have 2 more questions left. I've sort of whittled it down. For some people, I've sent my own private answers to. This is the first one is from Bill. He asked, would the program recommend doing Roth conversion and the timing of doing one? Does the program recommend the timing of doing one?
It doesn't recommend. That's where you have to manually optimize. You have to go in there to the retirement accounts and specify, hey, under here, under Roth conversion, add conversion amount. And you'd add the amount and you'd say when it's going to start. Well, maybe you're adding $50,000 and it's going to start. You want to do it starting when you're 60 and continue until you're 65. So 50,000 a year for like 3 years or 5 years, sorry. That's what you'd have to do. You'd have to do it manually, and then run it, comparing it with the with what your other alternative profile, your base profile was, or whatever profile you're working off of. You can compare any profile with any other profile, and then see whether your lifetime discretionary spending has gone up. And so instantly you can see whether this is a good thing to do, and whether you've gotten the right, done this the right thing. And if it has gone up, you might say, well, maybe I should do even more of it, or maybe I should do 50,000 for more years. So you can just come back to that profile and change it, or set up an alternative profile and keep everything very straight in terms of this profile does this profile does that, and very quickly get to the right answer for what to do. So what's the last question, Alex?
Okay, so the last question is from Hannah, and it's basically about a somewhat complicated case. So I'm going to read it out. It's a long question. And I think it gets to how flexible our program is to sort of figure out tough scenarios. So here we go. She says, I have a client trying to figure out how to maximize income in retirement while protecting the wife in the scenario that the husband passes away. They have a military retirement that disappears after the husband passes. They have 2 traditionals and 1 Roth. But the kicker is, they want to know what payout to take from the husband's pension when he retires. Do they take the single life and do a pension max with life insurance to replace the income if the husband matches? Do they do a 20-year guarantee and just let the IRAs grow? And that is what the wife lives off in the case that the husband passes away. Can your program help solve the scenario and yield the maximum payout while protecting the wife?
Yes, all these things that you mentioned can be dealt with and programmed as alternative profiles, all these different options in our program. You can specify an annuity, a pension, or an annuity with a survivor benefit. You can do contingent planning. So in the case of the husband's retirement account, pension, we're talking about that pension being around when he's around, but when he dies, it goes away. So we have something called contingent special receipts and contingent special expenditures, and when you enter those, you can say, well, right here, if Gene dies, will there be any change in that receipt? So you could enter the husband's pension, military pension, as a special receipt, specify that it's taxable at ordinary rates, but then specify that if the husband, if George dies, change it to 0 so that she doesn't collect it. And then the program is going to know that because of that, he needs to have some life insurance to protect her, protect Gene against his loss of the pension. So it will automatically figure out how much life insurance, additional life insurance he may need in order to make sure that she doesn't have a lower living standard. If she's going to have a higher living standard anyway, because maybe they have lots of regular assets, and she'd be better off if he were to die, it's not going to recommend life insurance. So all the things that you've raised, we can handle in our program, and we can help you and hold, certainly if you're learning how to use the program, we can help you on a one-to-one basis as you get, used to this software. I'd be happy to personally assist you in dealing with these different cases and showing you the different ways to handle those, because ones that are, really somewhat more challenging, I like a good challenge to figure out how to do it the easiest way in the software. But it's really versatile. Anyway, I think we've come to the end of the second XYPN webinar. I really appreciate your participating. I hope that you'll come to the next one, which is a week from Friday, to look at how the program, how Maxify Planner handles investment risk and gives people advice about how to invest through time, and also how aggressively to spend through time in the context of risky returns. And So once again, thanks again for coming, and we'll see you next time.